The stock market is closed today, Sunday, June 21st, 2026, meaning we are looking back at the final closing figures from the last active trading session for DataVault AI Inc., which trades under the ticker symbol DVLT on the NASDAQ exchange. The company finished that trading session at 41 cents per share, showing a modest intraday gain of 0.99%. While a move of less than 1% on a stock trading under $1 might seem like noise to the casual observer, the real story here is the explosive daily trading volume that accompanied this minor price fluctuation, with over 26 million shares changing hands against a 3-month daily average that has frequently surged closer to 46 million. This immense liquidity in a microcap asset signals that beneath the surface of this 40-cent asset, an intense corporate tug-of-war is playing out between retail speculators and institutional accumulation strategies. The immediate insight that most retail traders miss when looking at a penny stock like this is the hidden pattern of asset tokenization patents that the United States Patent and Trademark Office recently confirmed for the firm. While the crowd treats this stock as a simple speculative lottery ticket on their mobile phone apps, institutional data clearinghouses are quietly assessing whether the underlying intellectual property portfolio possesses an intrinsic value that far exceeds the current $350 million market capitalization. This creates an intense curiosity loop because the market is pricing the firm as if it is on the brink of structural insolvency, yet the underlying technology infrastructure is actively securing protective legal moats that could make it an attractive acquisition target for larger cloud infrastructure networks. When people talk about modern software infrastructure, the common ground or standard expectation is that you focus your capital on massive, proven, dominant tech names. Investors flocking to standard online investing websites look at megacaps, assuming that true technology value is only found in places like Tesla stock, Apple stock, or Nvidia stock. The general belief regarding DataVault AI Inc. is that it is a distressed, highly volatile microcap that has lost over 90% of its value from its 52-week high of $4.10 down to its current depressed state. The expectation is that this is simply another failed tech experiment burning through its remaining cash reserves before fading into obscurity. However, the reality challenges this narrative by forcing us to look at the massive shift in their core operational structure and their recent alliance frameworks with global enterprise providers. When you look deeper into the microcap space using an advanced interactive brokers platform or analyzing corporate filings through a standard individual brokerage account, you find that the company has been aggressively restructuring its entire balance sheet to transition from an older legacy hardware framework into a high-margin data licensing model. This counter-narrative suggests that the market might be mispricing the company by applying a traditional valuation metric to an enterprise that is functioning more like a specialized intellectual property holding company. To understand the recent daily swings, we have to look closely at the macroeconomic pressures and sector momentum currently hammering the broader microcap technology space. High interest rates have made capital incredibly expensive, forcing small-cap firms to rely on dilutive equity financing or toxic debt structures, and this company carries a fair bit of leverage that has kept conservative portfolios far away. The trading volume we're seeing indicates that massive blocks of shares are moving through dark pools, which is a classic sign of institutional positioning ahead of regulatory or corporate updates. Retail investors using standard online investment options like a basic Robinhood app or utilizing self-investing tools often get caught in the short-term noise of these daily swings without recognizing that institutional clearing firms are managing their risk exposure with massive automated systems. If you look at the recent earnings reactions, the structural tension between expectation and reality becomes glaringly obvious. In their last reported quarterly financials, the company posted a staggering net income loss of $53.13 million on revenue of just $3.42 million. This resulted in a deeply negative net profit margin that would terrify anyone looking for conservative investments through high-end wealth management structures or broad market indexes. Yet just 1 quarter prior, in late 2025, the company managed to post a brief flash of profitability with a net income of $661,000 on over $33 million in revenue. This wild instability explains why the stock experiences such massive trading volume and immense price volatility, as bulls point to the revenue potential while bears focus entirely on the massive cash burn seen in the early part of this year. Comment below how many shares of DataVault AI Inc. you currently hold, or if you prefer sticking to large cap equities within your retirement accounts. When you look at how people manage their wealth today, they often turn to automated options like Schwab Intelligent Portfolios, or use traditional platforms like Fidelity Investments to allocate their capital into broad index products like Fidelity ETFs or Fidelity mutual funds. Those automated systems completely filter out stocks trading under $1 because the risk parameters of an intelligent portfolio requires stability and consistent positive free cash flow. This means that a stock like this company is left entirely to active traders who utilize a Fidelity brokerage account or an Interactive brokerage account to place high-risk bets on distressed assets. This structural exclusion from major institutional indexes and mutual funds keeps the stock artificially depressed as it lacks the consistent buying pressure that passive index inflows provide to larger corporate names. Let us look closely at what this company actually does and how its underlying business model operates away from the chaotic trading screens. Headquartered in Beaverton, Oregon, the company operates as a technology licensing firm that focuses on securing and commercializing a portfolio of patented platforms designed for data management, valuation, and secure monetization. The core of their modern operational framework relies on specialized software agents that are categorized under corporate brands like DataVault, DataValue, DataScore, and DataVault Bank. Their primary goal is to provide a secure environment where large corporate enterprises can quantify the actual financial value of their proprietary datasets and safely trade or monetize that information without exposing themselves to cybersecurity breaches. Historically, the company operated with a significant focus on acoustic sciences and wireless audio technologies, which explains some of the older structural debt and legacy assets still lingering on their balance sheet. That past performance model struggled to gain mass market traction, resulting in massive annual losses, such as the reported earnings per share loss of $16.14 back in 2024. The realization that hardware-dependent licensing was a difficult path forced the executive team to pivot towards cloud-based data security and asset tokenization, a sector that boasts gross margins exceeding 72%. This historical baggage is exactly why the stock carries so much skepticism today, as the market is still punishing the company for past operational failures while failing to fully value the high-margin software architecture they are currently building. This brings us back to the core conflict between market narrative and operational reality when analyzing the future outlook for this asset. The company is currently facing intense legal scrutiny, with shareholder investigation announcements from firms like Robbins LLP and Johnson Fistel hitting the newswires, alleging potential breaches of fiduciary duty by corporate directors. For a retail investor browsing investing sites or checking their positions on a Fidelity mobile app, these headlines look disastrous and often trigger panic selling. However, institutional active traders looking at an Interactive broker's trading setup often view these minor shareholder lawsuits as standard noise that frequently accompany microcap restructurings and major corporate pivots. The future outlook for the company depends entirely on two contrasting scenarios that investors must weigh carefully before risking capital. The optimistic scenario hinges on the monetization of their recent asset tokenization patents and the expansion of their cloud-based data banking services, which could allow them to secure consistent, recurring enterprise licensing revenue. If they can replicate the revenue surge seen in late 2025, the current 40-cent share price will look like a massive structural anomaly, offering a significant upside that would reward aggressive investors using a SoFi trading platform or a specialized Robinhood stock trading account. The downside scenario is equally stark, driven by the brutal reality of their ongoing cash burn and the risk of severe equity dilution if they are forced to issue more shares to fund their $25 million quarterly selling and administrative expenses. When we evaluate this asset against the broader ecosystem of online investing, it becomes clear that it represents the absolute extreme of high-risk, high-reward speculation. It is the type of stock that completely disrupts traditional financial planning models because its success or failure depends entirely on binary outcomes like patent enforcement, corporate litigation, or sudden enterprise contracts, rather than steady, predictable macroeconomic growth. For an investor managing their own capital through SoFi Active Investing or exploring high-yield options on various tech-focused trading sites, this stock forces a complete reevaluation of risk tolerance. It stands in direct contrast to the safe, predictable returns that people seek when they buy into Fidelity IRAs or rely on a hands-off SoFi robo-advisor to build long-term generational wealth. To cleanly summarize the central insights of this analysis, the market is currently viewing DataVault AI Inc. through a lens of extreme skepticism, treating its 41-cent price tag as a sign of imminent corporate failure due to its historical losses and intense quarterly cash burn. The reality, however, reveals a company that has quietly built a robust, high-margin patent portfolio in the data security and asset tokenization space, backed by massive trading volumes that indicate significant underlying institutional interest. This deep contrast between the negative public narrative and the hidden value of their intellectual property is what creates the immense volatility we see on modern trading platforms every single day. Whether you view this asset as a dangerous value trap or a deeply undervalued technology play, it commands a level of attention and rigorous analysis that few other microcap companies can match in today's market environment. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor.
Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Bag chart. Don't forget to like, comment, and share this video to support the channel.